Hello, very good morning to all and happy Friday. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Friday, the 21st of June, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into our daily dose of market insights, so let's have a quick recap of what has taken shape yesterday in terms of the key economic data, news flow, and as well as some economic data that was released much earlier in today's Asia session before the start of our daily dose at 11 a.m. And how does this price release, or I'll say economic data release, relate to the respective price action of the various cross asset classes. So before we jump straight into the short-term intraday technical outlook, let's review these key events and data that took shape yesterday. So yesterday we do have two key central banks monetary policy meeting over here. So let me start off with the Bank of England first. All right, so let me flash the chart. So the Bank of England actually remains unchanged yesterday in terms of their benchmark interest rates. I would say the policy rate. So they maintain the policy rates at this 5.25%, but they actually painted a much more dovish picture, implying an imminent interest rate cut in UK, and very likely right now that is slightly based on the swap market. The market participants now price in slightly more than 50% chance of a move in August. So that should actually come right after the 4th of July UK snap parliamentary election. So that actually causes the sterling dollar to actually drop against the US dollar, but that came within our expectation for those who follow our daily dose of market insight yesterday, where in terms of the short-term technical intraday outlook, it has been showing signs of a sterling weakness to retest this week low, which was Monday's low, which indeed actually happened. So what's next for the sterling dollar? So do stay tuned. Later I'll cover on the short-term intraday technical outlook on the sterling dollar pair. So another central bank meeting will be the SMB. So the SMB actually kind of surprised the market because it actually cut the benchmark interest rate unexpectedly to 1.25%, another 25 basis point cut. And bear in mind, the Swiss central bank was the first major developed central banks to cut its rate way ahead of the other major central bank like ECB in March this year. So this time around, they go against the pack again by advocating another dovish stance. And what's interesting over here is that they also kind of reduce their inflationary forecast in Switzerland as well. All right, so this is the Swiss interest rate, no, Swiss inflation rate, which is at this hovering at 1.2%. And what they did over here is that in the pink line, which is the June meeting, they actually reduced their interest rate forecast going forward next year and the year after. So this is the pink line. So notice that the pink line starts to drop drastically way below the blue line, which was the earlier inflation forecast that was released in their previous monetary policy meeting in March. So bear in mind, just a quick recap. The SMB do not conduct monetary policy meeting every 2 months or 1 month. So indeed, they conduct their monetary policy meeting on a quarterly basis. So the next meeting will be out in September instead. So given this much more dovish stance that adopted by SMB, so we start to see the recent strength of the Swiss franc against the euro against the dollar starts to reduce its strength, and we start to see a sell-off intraday on the sterling, okay, on the Swiss franc against the dollar. So what we could see, I mean over here is that if you look at the chart, the spread chart, all right, the 5-day rolling performance chart of the dollar against the major currency pair as of now. So we could see over here previously this green line here is the dollar Swiss. So the dollar Swiss was the weakest among the major currency, indicating Swiss strength, also driven by the fact of that inflows due to that political uncertainty element that is arising from the upcoming French legislative election that's to be held on the 30th of June, the first round of it. So yesterday's much more dovish stance adopted by the Swiss central bank, the SNB, causes the spike up in the dollar Swiss, all right, and now the dollar Swiss starts to trade sideways as we are speaking at this juncture over here. So if you look at the other currency, right, that is pretty much I would say that it's much more of a sideways movement rather than any clear dollar strength or dollar weakness. But one thing that caught our attention is the ever ongoing dollar strength that has been in the last 1 month since the start of this month against the dollar yen. And later I'll share with you the technical elements chart of the dollar yen is now fast approaching a level that actually induces the prior very massive FX intervention undertaken by the Bank of Japan as instructed by the Ministry of Finance. It's really hit that very approaching to that level in yesterday's US session. So later I'll cover it when more on the short-term intraday technical outlook on the dollar yen. Okay, so that is the key data that was released yesterday. And one particular interesting data that I'm going to highlight over here is that also related to the dollar yen was released earlier this morning is the Japan nationwide inflation data. So if you look at the economic calendar very quickly, the nationwide economic data for Japan, so I would say it's rather a mixed showing. If you look at the core inflation rate, that is only excluding we call it energy price. It actually rose to 2.5%, above 2.2%, and slightly below market expectation of 2.6%. So if you were to open this chart itself, we don't notice that the trend has starts to actually plateau out. All right, so previously it was showing a sign of a deceleration from 4.2%, it went all the way down to 2%, then thereafter it kicked up again, then it went down, and now it starts to plateau off around this area here. So this is kind of an encouraging sign for Bank of Japan. Why? Because do not forget, Bank of Japan need to see a kind of firmer inflation trend that is able to be sustained at that 2% level, all right, 2% level before they embark on much more forceful normalization monetary policy. Still recall in March for close to about 6 to 7 years, they actually started to do a first interest rate hike to bring the short-term policy rate away from negative territory. And in order for them to be floating into much more positive territory, the Bank of Japan has really give its previous monetary policy kind of guidance in the last few monetary policy decision that the things that they are looking out for will be stabilization of inflation rate in Japan that should hold around the 2% level for a sustainable period of time. So that's one thing to look at. But if you look at another subset of the Japan inflation metrics, because they don't, because you know that Japan itself is quite unique, they have this core inflation and core inflation. So core inflation strip out the food and energy prices, fresh food and energy. So if you look at the core rate over here that is excluding fresh food and energy, actually went down lower than the previous month of 2.4%. So it came out at 2.1% instead. So what we could see over here, right, the trend of it continues to decelerate over here, and now coming very close to that 2% mark where Bank of Japan is monitoring. So it doesn't seem to be plateauing around at the 2% level, but showing signs of a deceleration. All right. So on the other hand, another key key economic data metrics that is I want to share about in Japan will be the services sector. So we know that the services sector in Japan in the last few 12 months or so has been one of the pillar to support a kind of a much more improvement in Japanese GDP growth, has in fact now flashed down to negative territory. All right, so if you look at this is a flash data released by S&P, the compiler. So this S&P services Japan PMI flash data for the month of June actually slip down to a contractionary mode. So anything that's below 50 is doing is contraction. So from 53.8 it slipped down to 49.8. So if I were to open up over here, okay, so the trend actually plummeted to quite low. If you look at the quite drastic plunge over here at this point in time. So this level here, if you look at the trend, it's almost the lowest level that was seen in August 2022. So coming close to a 2-year low at this point in time. So it is an outlier. Yeah, potentially it could be an outlier due to some data point. But if it starts to develop into a trend by next month showing another sign of a contraction, there is a big chance that BOJ may not be able to normalize its ultra accommodative policy as its wish. That means we're talking about going forward, it will be pretty tough for BOJ to actually starts to think about doing another interest rate hike instead. So that could also be the reason to actually support a much more weaker yen going forward if from a medium term perspective. Okay, so that's from a longer term horizon. All right, so these are the two, but one thing positive over here is we look at the manufacturing data from Japan. Okay, so they release both the manufacturing and the services. So the manufacturing PMI, the flash one, actually managed to hover around the 50 level mark. That means I think that's 50 is expansion, but the growth of the expansion slightly ticked down lower from the previous month of 50.4, and it came slightly below expectation of 50.6. So if you look at the trend over here, okay, it starts to tick down lower. But what's interesting over here is that it's not doing a kind of a lower. So it seems to be also showing signs of improvement, plateauing out at around the 47 area that was printed in February and in February last year. All right. So overall, if you look at this set of data that I shared from Japan, the core inflation, the flash PMI for the services and the manufacturing sectors is rather mixed at this juncture. All right. So now with that, let us now take a step forward and let us now starts to have a deep dive into the short-term intraday technical outlook on the cross asset, on the various cross asset classes, starting with the FX market first. So let us now start with the FX market by going into the sterling dollar. Okay, the euro dollar first. Okay, let's take a look at the euro dollar. All right, so before that, let me expand my screen so that you guys could take a bigger look, a bigger picture of it. So for the euro dollar, yesterday we do have a bullish bias holding above the 0.710 short-term pivotal support level. So what's interesting over here is that the euro dollar actually came down, it plunges, play around the short-term pivotal support level before it shaped a rebound during today's Asia session as well. And what's interesting over here is that the way it came down at the 0.710 short-term pivotal support, it actually retraced a 61.8% retracement of that previous push up, okay, that was taken shape from last Friday low. Okay, the 61.8 Fibo retracement corresponding to the pivotal support that we highlighted yesterday as well. So this we have a Fibo retracement adding on as an additional layer to a graphical support. And what's interesting over here is that in conjunction, upon hitting the short-term pivotal support level, we start to see a bullish divergence on the RSI, okay, indicating to us that the downside momentum has started to ease off, at least in the short term. So with that, with these two positive new technical element that is being surfaced on the euro dollar, we will still maintain that short-term intraday bullish outlook on the euro dollar, keeping a bit of excess below uh, at 1.0710 to 1.07 figure level. So it's an excess around this zone here, 1.0710, 1.07 figure level as my short-term pivotal support level. Still maintain that short-term intraday bullish outlook for that potential minor counter trend rebound to play out again. So first support level, first resistance level to watch, pardon me, will be at 1.0730 level. A break above this level exposes 1.07710 and 1.0770 slash 1.0790. Only hourly close below 1.07 figure level will invalidate this short-term intraday bullish bias to see another round of weakness to float down to test 1.0656. A breakdown below 1.0656 exposes 1.062, 1.06 figure level, which is this minor swing low area of 16th of May, 16th of April, and 18th of April. Okay, that's for the euro dollar. So sterling dollar, yesterday we do have a bearish bias ahead of the BOE meeting. So it came down and hit the support level as expected at 1.2610. And very similar, upon hitting the support level, we start to see a bullish divergence as well on the hourly RSI. Very similar price action on the hourly RSI of the euro dollar. So with this positive development on the hourly RSI indicating to us a slowdown in downside momentum, we will now flip to a bullish intraday bias today for the sterling dollar using the 50-day moving average and the former minor swing high area of 3rd of May as my short-term pivotal support for today, slightly below the 1.2660 level, 1.2610. So 1.2610 will be my short-term pivotal support on the sterling dollar, flip to a short-term intraday bullish bias. First resistance to watch will be the 200-day moving average acting as a resistance level as well at 12740. Right, which was yesterday's swing high, Wednesday swing high area that induced that minor sell off on the sterling dollar yesterday. So only an hourly close below 1.2660, no, only an hourly close, pardon me, below 1.2610, that is the short-term pivotal support level, will invalidate today's short-term intraday bullish bias to see another round of further weakness on the sterling dollar to flow it down to the key 200-day moving average at 1.2565. If this level doesn't hold, potentially we may see further weakness to retest the minor swing low of 10th of May and 30th of May that is acting as the next near-term support at 1.2510. Now, moving on, next will be the Asia Pacific dollar pair. Let us start with the Aussie dollar first. All right. So the Aussie dollar, pardon me, the Aussie, okay, the Aussie dollar over here pretty much resilient yesterday, hitting the first support level before it tried to shape a bounce over here. And what we could see, the bounce off of the first support also corresponding to the bounce off from a parallel ascending trend line. Right now, I drew on the hourly RSI. So indicating to us some signs of short-term bullish momentum that it still remains intact on the Aussie dollar. So with that, no change. I'll be still using the 6640 as my short-term pivotal support level to maintain the intraday bullish bias on the Aussie dollar within its medium-term symmetrical triangle range configuration. And this 6640 also confluence with the 20-day moving average that's acting as a support level as well. So with that, we do have a tighter first resistance to watch for today because given it's Friday, there will be okay 6680, which was yesterday's minor swing high. So 6680 will be my first resistance to watch. Above 6680 may expose the next intermediate resistance at 6710, which is the minor swing high area of 16th of May and 17th of May. Only an hourly close below 6640 will invalidate this intraday bullish bias on the Aussie dollar to potential expose it towards this lower limit of this minor, we call it a sideways range configuration that has taken shape since the low of 10th of June the next near-term support level to watch will be at 66.10, and the lower limit of this sideways range, which is also confluence with the 50-day moving average, I think it's a support at 65.90/65.80. All right, so now moving on will be the dollar yen. So what is interesting of the dollar yen? Yesterday we do have for this week, in fact for late last week, we do have a bullish bias, and in fact it is now floated up towards the lower limit of this long-term pivotal zone at 159.50. The upper limit is 160.30. So what's 159.50? 159.50 is in fact this swing high area of 29th of April. And why is it important? Because that actually induces this big sell-off, intraday, a big multi-day sell-off in the dollar yen previously, that was actually being triggered by that massive FX intervention from BOJ as instructed by the Bank of Ministry of Finance, pardon me. And with that, if you were to look at this situation over here, is that at this point in time, the current price action yesterday push up also confluence with the upper limit of this minor ascending channel that I drew from the low of 5th of June. And since upon hitting close to the 159.50 lower limit of the long-term pivotal resistance zone, the hourly RSI has really hit an extreme overbought level. And upon hitting the extreme overbought level over here, so this is the most overbought level since that intervention day on 29th of April. You could see over here. Okay, so this is the second most overbought level within 2 months. All right, but what's interesting about hitting the extreme overbought level, the RSI has started to shape a bearish divergence. Okay, we see it very clearly, a lower high over here. So what it means, it tells us that this momentum is a bit overstretched, all right, and the upside momentum is losing strength as well by flashing this bearish divergence as being seen on the hourly RSI. So with that, given that it's coming very close to the long-term pivotal resistance zone, the lower limit of 159.50, I will actually flip to a short-term intraday bearish bias, at least for a potential intraday mean reversion pullback on the dollar yen. First support level to watch will be the breakout level that has been taken out on Thursday at 158.30/158 figure level. This area here, a break below 158 figure level potentially will see it floating down towards the 20-day moving average that's acting as a support level as well. That also confluence with the lower limit of this minor ascending channel that I drew from 5th of June and the minor swing low of 14th of June, all confluencing at the 156.90 level. But however, if we start to see an hourly close above 159.50, then potentially we could see it floating upwards towards the upper limit of that long-term pivotal resistance at 160.30. All right, so that's for the dollar yen. So with that, that kind of sum up the short-term intraday technical outlook for the dollar major pair or on the FX market. So with that, let us now move on to the major stock indices, starting with the Asia Pacific indices, the Nikkei 225 or the Japan 225. So the Nikkei 225, as usual, yesterday it broke above the first resistance level that we highlighted at 12875 before it shaped a pullback again during yesterday's US session and in fact in today's Asia session as well. So with that over here is that the first support level to watch will be the 50-day moving average. So it's now being sandwiched between the 220-day moving average and the 50-day moving average over here. So still no change, still using that 38,240 as my short-term pivotal support level to watch out for. But in order to see a much more increased odds of a bullish momentum floating back into the Japan 225 on an intraday basis, it got to have an hourly close above 38,750. So hourly close above 38,750 brings us up the next resistance, near-term resistance to watch will be at the minor swing high of area of 14th of June at 39,020 or close to the psychological level of 39,000. Above it sees 39,290. But however, if we start to see an hourly close below 38,240, then we will start to see another round of further weakness to actually allow it to potentially float down towards the sideways range configuration that has been taken shape since the low of 30th of May at the range support of 37,960. A break below it exposes the low of 30th of May at 37,630 next. Okay, so that's for the Japan 225. So overall, there is still no very clear trend of the Japan 225 or the Nikkei 225. It still continues to be kind of a trap within a complex sideways range configuration since the end of May or the earlier part of June, I would say. Now, moving on next will be the Hong Kong 33 or the Hang Seng index. So weakness continues to actually be prevailing against on the Hong Kong 33 after a reintegration back into that 20-day moving average and breaking below yesterday's short-term pivotal support level that we have at 18,070. So right now, potentially, I will use the 20-day moving average as my short-term pivotal resistance for today, 18,300, potentially revisiting this Monday's swing low area at 17,780. A breakdown below it's potentially expose much more weakness towards 17,600, which is the minor swing low of 1st of May over here. All right, so flipping to a short-term intraday bearish bias, holding below 18,300 short-term pivotal resistance on the Hong Kong 33 or the Hang Seng Index. Only an hourly close above 18,300 will flip back to a bullish stance on the Hong Kong 33 to see it testing the next near-term resistance level at 18,730, followed by 18,980 next. So that's for the Hong Kong 33 short-term intraday technical outlook, given that price action has already broken below the 18,070 level. So we got to respect the price action. So it seems to us that the bullish momentum is on hold again on the Hong Kong 33. So unless it's able to break above 18,300 for today, which is the 20-day moving average, I think as a short-term pivotal resistance that we have for today. All right. So with that, let us look at the German stock market, which is the German DAX. So the German DAX right now is actually floating up to the short-term pivotal resistance that we highlighted since Wednesday, 18,240 level. So no change, still using 18,240 level to maintain that short-term intraday bearish bias on the German 30. So for the first support, I will have a higher level to watch out for today, which is the minor swing low area of Tuesday and as well as yesterday, which is at 18,070. Only a break below 18,070 potentially could revisit last Friday swing low area at 17,990/17,930. But however, if we start to see an hourly breakout above or close above 18,240, then this particular intraday bearish bias will be invalidated to see the continuation of this push up, means the extension of this corrective rebound towards the next resistance level at 18,380 and potentially 18,520 as well, which also confluence very closely with the 50-day moving average and the 20-day moving average acting as a resistance area. All right, so that's for the German DAX or the German 30. Now moving on will be the major US stock indices. So the major US stock indices, very interestingly, the US Wall Street Dow Jones actually outperformed against the Nasdaq 100 yesterday. Why? Because of a sell-off in the semiconductor stock. So before we jump into the US Wall Street 30, let's have a quick look at the heat map of the S&P 500. So I could see on the S&P 500 yesterday, yes, we do have more greens that we have, but however, the red that is surrounding in the mega cap stock got hit, especially starting from the semiconductor, which is AI driven. So we see a bit of profit taking on this AI optimism theme play that has taken shape on an intraday basis. So given the fact that in fact there are still more greens that are available in the S&P 500, that particular uptrend that was seen in the US stock market that has taken shape a month or so, it still remains intact. All right, so now with that, let's quickly jump straight back into the short-term intraday outlook on the US Wall Street 30 again. So the US Wall Street 30, if you recall, yesterday we do have a bullish bias, and indeed it hit the upper limit of this range resistance that was earlier in place since 7th of June and 12th of June. So that was the resistance of this ascending triangle range, minor ascending triangle range. So yesterday it did a bullish breakout of it. All right, it did a bullish breakout, and right now it do a retest at this level. Okay, so now this level here will turn into a pullback support for today. right, at this 38,090, 39,090, 39,130 level. So with that, right, I will have a slightly tighter key short-term pivotal support for today. Okay, at this level over here. Okay, give me a minute. Let me copy this. Okay, so this level will be 38,940. Okay, so this level will be the next one. Oops. Okay, so this will be no longer the short-term pivotal support. All right, so with that, this could be the first support level to watch, the potential pullback at 39,090. So, but I don't want to put it so tight. I'll use it slightly lower at 39,940. And if you look at 39,940, also confluence with this on starting of a new ascending minor channel after the bullish breakout from the ascending triangle range resistance over here. Okay, it also linked to the lower limit as well of this ascending channel support. So as long as any potential pullback today didn't surpass below 38,940, we'll still maintain that short-term intraday bullish bias on the Dow Jones Industrial Average, which is the Wall Street 30. Next resistance level to watch will be at 39,390, followed by 39,600 next. Only an hourly close below 38,940 will kind of invalidate yesterday's bullish breakout move. That means yesterday is considered a failure bullish breakout. To see another round of choppy corrective movement back into the range again, the next support level to watch will be at the 20 and the 50-day moving average, acting as a confluencing level at 38,730. A break below it exposes 38,560 next on the US Wall Street 30. Now, very interestingly, on the Nasdaq 100, so if you look at the Nasdaq 100 over here, yesterday it actually shaped that pullback, which was intentionally expected, and that pullback managed to be held right at the 19,700 short-term pivotal support level. All right, so and that pullback also took shape right at the first resistance that we highlight as well, 20,120, 20,155. So no change, still maintain that short-term intraday bullish bias on the Nasdaq 100 after this pullback has managed to be kind of storing at the 19,700 short-term pivotal support that we highlighted yesterday, and the RSI also now tried to exit out from its oversold region as well. But for today, we will do have since it's Friday, we do have a first resistance level to watch that is slightly lower than the 20,120 level, which is this level here. All right. Okay, at 19,990. So first resistance level to watch 19,990, a break above it, revisit the 20,120 slash 20,155 level. Only an hourly close back below 19,700 will invalidate today's intraday bullish bias on the Nasdaq 100 to see a deeper corrective pullback towards 19,480. Below it exposes 19,240 slash 19,100. That means we should also kind of mean revert it, a deeper mean reversion decline back to retest the rising 20-day moving average as well. Okay, so with that pretty sum up today's intraday technical outlook on the major stock indices. So I would say it's a rather mixed bag situation right now we are facing on an intraday basis. So with that, let us now touch on the commodities market, starting with this gold XAU slash USD. So for gold XAU slash USD, if we recall yesterday, we flipped to a bullish bias, and now price action indeed actually ran up and cleared above the 20 and the 50-day moving average. And interestingly, right now it's coming very close to the swing high area of 7th of June that induces that previous steep decline during that period in time. So those who recall, this particular steep decline was due to the release of the China FX reserve that indicate that they did not buy gold bullion for the month of May. So what you could see very interesting over here is that the RSI also hit the overbought zone yesterday, and upon hitting the overbought zone, there was a bearish divergence that is being flashed out as well. Lower high, but similar high on the gold price action. So with that, there could be a chance of a potential minor corrective pullback that could take shape today, given the bearish divergence that's being flashed out on the hourly RSI and is fast approaching this important minor swing high area of 36,000. 2,386, a bit of time twisting. So I'll be using 2,386 as my short-term pivotal resistance today, flip to a bearish bias for a potential intraday mean reversion pullback scenario to unfold in XAU/USD. Resistance, no, support level to watch will be this area here. This was the kind of a bullish breakout area, which is the 20 and the 50-day moving average as well. 2,338 followed by 2,325. Okay, unless we start to see a breakdown below 2,325, then the potential mean reversion decline could be much more deeper to test 2,308, which is the minor swing low area 18th of June and confluencing with the minor ascending trend line that I drew from 10th of June as well. And if you do the Fibo retracement, that could actually retrace close to 50% of this push up. Okay, no, in fact, not close to the 76.4% and the golden ratio. Okay. However, if we start to see an hourly close above 2,386, then this particular recovery could extend to kind of expose the next near-term resistance at 2,410. A breakout above 2,410 may revisit the current all-time high area at 2,450 next. Okay. Now, lastly will be the oil market, the WTI crude oil. So WTI crude oil right now, we continue to see testing that 81.90 short-term pivotal resistance yesterday, and what we could see is that we see the continuation flashing out of that bearish divergence over here as well. So still no change, still using 81.90 as my short-term pivotal resistance level to watch, potentially for that intraday mean reversion decline to actually take shape. We do have a shorter, higher near-term resistance, a near-term support level to watch will be at this area here. Okay, which is confluencing with yesterday's and Wednesday minor swing low at 80.70. Breakdown below 80.70 kind of revisit this prior resistance zone, turns into a pullback support at 79.45 slash 78.90 area over here. Okay, over this area here. However, if we start to see an hourly push up above 81.90, then this ongoing recovery could extend towards the next resistance level to watch out for will be 82.90, followed by the one-time Fibo extension of 84.90. 84.40, pardon me, we also confluence with the swing high area of 26th of April. Okay, so that sums up the short-term intraday technical outlook of the various major cross asset classes. So before we go for today's, let's have a quick look at the calendar of what other data to look out for today. So today will be the release across the globe of this flash manufacturing and services PMI data as compiled by S&P. So during the European session at Singapore time at 3:30 p.m., you'll see a slew of similar releases, services and manufacturing PMI in the Eurozone, starting from France at 2:45 p.m. and 3:30 will be in Germany, and at 4 p.m. will be the Eurozone wide release of the manufacturing PMI and the services PMI data. So that's 4 p.m. And going down to 4:30 p.m., you'll see the release of the UK one at manufacturing and the services, okay, releases as well for the UK flash PMI data release. And with that, 9:45 p.m., we see the releases of the flash PMI, services and the manufacturing one at 9:45 p.m. for the US side of the story. All right, and over here at 10 p.m. we do have one conference board leading economic data release at 10 p.m. So previously they showing continuous signs of a deceleration at negative 0.6% month of month. So this time around the consensus is expecting a slight slower pace at negative 0.3. So something to look out for at 10 p.m. Singapore time, and thereafter it will be a rather quiet US session, so there is no Federal Reserve official speaking for today. All right, so with that, I wish you all a great day ahead and a more restful weekend, and we shall speak again on Monday. So this is Kelvin signing out. Thank you.